What is the difference between cash flow analysis and fund flow analysis? Let us understand. Cash flow analysis analyzes the cash flow movement of an entity by dividing the activities of the organization into three categories. Basically, we will have cash flow from operating activity, cash flow from investment activity, and cash flow from financing activity. So by going through this, we will know from which activity entity is making money and in which activity they are consuming money or they are losing money, and it will give a overall picture. Let's say for example, a business is generating 100 crore cash from operating activity and it is spending 40 crore in investment activity and repaying 50 crore in financing activity. If we are getting this information by going through the cash flow statement, it actually helps us to get the pulse of the business, because they have made 100 crore from operations and they have used some portion of it for investment and something for repaying the loans or paying cost of the loans, whatever. And you get to know that they have generated overall 10 crore during the year. So if we can add this cash generated with the opening cash and cash equivalents, let's say it is 2 crore, then automatically we will also get the closing cash and cash equivalents, and that is 12 crore. So in this way, cash flow analysis helps us to understand which activity is generating money and in which activity money is spent. So the focus is on the activity, whereas fund flow analysis puts the focus on time. It means funds are classified on the basis of time. So we are going to have funds that have come from long-term sources, the funds that are used for long-term uses. Similarly, we will have funds that have come from short-term sources and funds that are used for short-term uses. When I say long-term, this means they have come from the source where the money need not be repaid in short term. It means if at all they have to be repaid, it is only after 1 year. So long term means after 1 year. And when I say short term, this means money has come from source and if at all they have to be repaid, they got to be repaid within 1 year. Similarly, when I say short term use, it means they are deployed for short-term purposes and that money is likely to come back within 1 year. This understanding is very important because if a business raises, let's say, 100 crore from long-term sources and spends 60 crore for long-term use, it means it will have a surplus of 40 crore under long-term category. This is long-term surplus. So they can use this long-term surplus for supporting any requirement that can arise in short-term nature. Let's say for example, the same entity is raising short-term sources of 20 crore, but on the short-term usage side, their requirement is 60 crore. It means they are facing a shortage of 40 crore. Now, this surplus can be used for funding the shortage. So this long-term source surplus is now used for supporting the short-term requirement, and that is considered as a healthy sign. Only condition is this 40 crore should not have been tied up for any other long-term purpose requirements. So this is a typical fund flow analysis, because here you understand that how much funds have come from long-term sources, how much has been used for long-term uses, and whether they have any surplus or deficit. In this case, there is a surplus and that surplus has been used for supporting the deficit on the short-term side. Let me give you another scenario. Let's say the business has raised 100 crore on the long-term side, but they have spent 150 crore for long-term uses. It means they had a shortage of 50 crore on the long-term front. And on the short-term side, they have raised short-term sources of 70 crore, but what they have spent for short-term purposes is only 20 crore. It means on the short-term side, they had a surplus of 50 crore. So what they did, they diverted this short-term surplus for this long-term deficit. Why? Because They have to spend 150 crore, they have only 100 crore, so there is a deficit of 50 crore which is managed from here. But this is not good for any business, because here they are diverting the short-term funds for long-term purpose, which is considered as financial indiscipline, because this diversion will bring in a lot of troubles and problems for this entity. So these kind of things will come out when you do the fund flow analysis. Here, when you compare the long-term sources with uses, you are able to identify the deficit, and you could also understand how this deficit was funded, because it is very evident that this deficit is funded out of short-term sources. Here we go, Credit and Financial Analysis Mastery Course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.